What if I told you that the entire global artificial intelligence revolution, the massive brains behind ChatGPT, the algorithms executing billion-dollar trades on Wall Street, and even the highly classified sovereign data of entire nations, what if I told you all of that physically lives inside a single company's buildings?
Yeah, it's wild to think about.
Right, because we talk endlessly about the cloud as if it's this, invisible, ethereal mist floating above us. But the cloud is not in the sky. It is heavy, it is incredibly hot, and it is made of concrete, steel, and just thousands of miles of fiber optic cables. So today we aren't looking at the software. We are looking at the concrete.
Which is honestly, it's the ultimate blind spot for most tech observers. I mean, we get so caught up in the magic of the algorithms that we completely ignore the physical laws of the universe required to actually run them.
Exactly.
The infrastructure powering this era is just hiding in plain sight. What sounds on paper like a dry zoning update or like a commercial real estate leasing metric is, in reality, a leading indicator of where global technology is heading over the next 10 years.
Welcome to the deep dive. We are taking a slightly unusual approach today because we got our hands on a document that is usually reserved for Wall Street analysts desperately trying to hit their quarterly targets. We are looking at the Q2 2026 earned call transcript for Equinix, ticker symbol EQIX.
Yeah, this one is a gold mine.
It really is. But we're using this corporate earnings call as a decoder ring. Our mission is to strip away the Wall Street jargon, bypass the safe harbor statements, and extract the actual physical reality of the AI boom from the numbers. Whether you hold this stock, you're thinking about your portfolio, or you're just, insanely curious about how the internet physically functions when you ask an AI to write a poem, this deep dive is custom tailored for you.
Equinix is just such a fascinating entity to dissect, because they are largely invisible to the average consumer. Yet almost every digital interaction you have, every streaming movie, every credit card swipe, every AI prompt, it all passes through their real estate at some point.
Okay, let's unpack this. Because Equinix isn't just a data center company throwing up warehouses with loud air conditioners in the middle of a cornfield, right? They are the physical intersection where the internet and artificial intelligence meet. They provide the space, the immense amount of power, the cooling, and the physical fiber connections that allow the digital economy to communicate. And when their CEO, Adair Fox-Martin, and CFO, Olivia Leonetti, started reading off their second quarter results for 2026, the sheer scale of the operation became pretty undeniable.
Oh, absolutely. The top line metric that really sets the baseline for this entire conversation is their revenue growth. Total revenues increased by 16% year over year. Wow. Yeah. And for a company operating at a multi-billion-dollar global scale, growing the top line by 16% represents just a massive influx of absolute dollars. But, Wall Street analysts are notoriously skeptical of top-line revenue because it can be manipulated, right, by one-off deals or accounting anomalies. So the real health of this business lies in the recurring metrics.
Which brings us to MRR, or monthly recurring revenue.
Right.
The transcript notes that their MRR growth accelerated to 11% on a normalized basis, marking their third straight quarter of double-digit MRR growth. I want to linger on this for a second because it's critical. This means the baseline rent they collect every single month without having to go out and make a single new sale is compounding at over 10%.
That compounding effect is the holy grail for a real estate business. I mean, it's what every landlord dreams of, and it's supported by their forward-looking indicator, which is annualized growth bookings. Bookings grew 23% to $424 million in this quarter alone.
Wait, $424 million in one quarter?
Yep.
That is the second highest volume they have ever recorded. And a booking is essentially a signed, non-cancelable contract for a future deployment. So the recurring revenue is growing in the double digits, but the pipeline of new business waiting to physically install their servers is accelerating even faster.
I want to translate their business model into a real-world analogy to make sure we are all visualizing this correctly. So think of Equinix as a highly specialized landlord. They own the apartment building. The servers owned by Amazon, Google, or Wall Street Bank are the tenants. Equinix charges rent for the physical room and the electricity. But the genius of their model, and the reason those recurring revenues are so high, is that they also charge you every single time you want to use the hallways to go talk to your neighbors.
Yes. Those hallways are what the industry calls interconnections, and it is a wildly lucrative business model.
It is. Imagine your apartment landlord charging you a $50 monthly fee because you ran an extension cord under the door to share your neighbor's Wi-Fi. In the real world, you'd move out immediately. But in the corporate world, this is a massive profit center. Well, because the neighbor in the scenario isn't, streaming Netflix. The neighbor is an Amazon Web Services direct on-ramp or the matching engine for a major financial exchange. Connecting directly to them via a physical fiber optic cable inside the Equinix building is exponentially faster, cheaper, and infinitely more secure than sending your proprietary data out onto the public internet and just waiting for it to bounce back.
With that landlord analogy in mind, there's a specific profitability metric in this transcript that completely stopped me in my tracks.
The AFF.
Yeah, their AFFO per share. That stands for Adjusted Funds from Operations. Since Equinix is legally structured as a real estate investment trust, or REIT, AFFO is basically their version of earnings per share. Their AFFO per share grew by an astonishing 18% on a normalized basis.
We should probably break down why AFFO matters so much more than traditional net income for a company like this.
Good idea.
When you build a massive data center, traditional accounting rules force you to depreciate the value of that building over time. That depreciation shows up as a massive expense on the income statement, artificially dragging down the official net income.
Right, because buildings age.
Exactly. But a data center doesn't actually lose its operating value that way, right? It's still sitting there generating cash. So AFFO adds that non-cash depreciation expense back in, giving you a true, unvarnished look at the actual cash the business is printing.
And printing cash at an 18% higher rate than last year is phenomenal. But I have to push back here. I am looking at this 18% AFFO growth, and I'm also looking at their adjusted EBITDA margin, which suddenly spiked to a massive 53%.
Yeah, the 53%.
That is a 300 basis point jump year over year. You don't just suddenly become 3% more profitable across a global real estate portfolio overnight through sheer willpower. Tell me there isn't a one-time fluke hidden in those numbers, because Wall Street severely punishes companies that try to pass off a windfall as a sustainable trend.
What's fascinating here is how the CFO proactively managed that exact skepticism on the call. Because you are completely right to view a 300 basis point margin expansion in a capital-intensive business with suspicion. There was an anomaly. Yeah. In the transcript, management details the closure of 134 megawatts of what they call X-scale leases, heavily driven by a specific transaction they refer to as the Ampton deal.
Let's decode X-scale. What is that?
So X-scale is their internal branding for hyperscale deployments. These are just unfathomably large footprint deals, usually signed by the giant cloud providers like Microsoft or Google, who need entire data halls, not just a few racks. For this quarter, those 134 megawatts of X-scale leases came with approximately $120 million in non-recurring fees.
Non-recurring. There it is.
Yeah.
$120 million one-time setup fee that drops straight to the bottom line.
Exactly. That $120 million artificially inflated the adjusted EBITDA margin up to that 53% mark, creating the 300 basis point illusion. However, and this is key, if you strip that anomaly completely out of the model, like if we pretend the Ampton deal never paid that upfront fee, the adjusted EBITDA margin is still up 150 basis points year over year.
Okay, so half of the margin expansion was a fluke, but the other half, improving profitability by 1.5% on a multi-billion-dollar run rate, is pure structural operational leverage.
It proves the core engine is scaling efficiently, and the pricing power driving that efficiency is tied directly to those hallways we discussed. They added a record 9,700 net interconnections in a single quarter.
Nearly 10,000 new physical or virtual cross-connects between tenants. That's insane. And while they are wiring up all these new connections, their churn rate, the percentage of customers abandoning their leases, is sitting at 1.8%. For context, the CFO noted their historical churn typically bounces between 2 and 2.5%. So they are outperforming their own historical bests.
This raises an important question regarding market dynamics. Equinix is universally recognized as a premium price provider.
Right, they aren't cheap.
Not at all. If you just want cheap power and space, there are cheaper operators. So why is their churn essentially non-existent? The answer lies in a concept called data gravity and the resulting ecosystem lock-in.
Data gravity, I love that term. How does data have gravity?
Think of data like a physical mass. The more data an enterprise accumulates in one location, the heavier it gets. If you are training a large language model and you have petabytes upon petabytes of proprietary information sitting on servers inside an Equinix facility in Ashburn, Virginia, moving it to a cheaper competitor across town is a logistical nightmare.
You can't just throw petabytes of data on a hard drive in the back of a Honda Civic.
No, you really can't. Moving that data over a network incurs massive egress fees from your cloud provider. It requires significant physical downtime. But most critically, moving the data breaks all of the physical interconnection hallways you have established with your partners inside that specific Equinix building.
Which means leaving Equinix isn't just canceling a real estate lease. It is actively unplugging your business from the local digital economy.
Exactly. If you're a financial trader and you move your servers out of Equinix to save 10% on rent, but you sever your direct physical connection to the exchange's matching engine down the hall, your trades suddenly take 3 extra milliseconds to execute. In modern finance, you just saved a few $1,000s on rent and completely destroyed your algorithmic trading advantage. The CEO highlighted this pricing power on the call. Customers are absorbing the premium cost because the value of being physically integrated into the ecosystem far outweighs the rent check.
So the foundation of the business is rock solid. The recurring revenue is compounding, margins are structurally expanding, and data gravity is keeping churn at historic lows. But what is the catalyst right now? Why is the volume accelerating so violently in Q2 2026?
The entire narrative of the call, repeated by management across multiple questions, is that the AI-driven infrastructure cycle is accelerating faster than anticipated. And they used a very deliberate phrase to describe Equinix's position in this cycle. They called themselves the neutral ground.
Neutral ground. That sounds like a diplomatic term, not a tech strategy.
It does, but historically, Equinix's entire multi-decade rise was built on neutrality. Back in the early days of the internet, they were the neutral room where viciously competitive telecom providers like AT&T and Sprint met to exchange traffic.
Oh, interesting.
Yeah. Then they evolved into the neutral ground for the multi-cloud era. If an enterprise wanted to use AWS for storage, but Google Cloud for analytics, they did it inside Equinix, because Equinix doesn't have its own cloud. They don't compete with their tenants.
And now they are pitching themselves as the neutral exchange for the AI era.
Because the AI ecosystem is incredibly fragmented, enterprises are terrified of vendor lock-in. They want the freedom to use an open AI model today, an Anthropic model tomorrow, and a proprietary open source model next week, all utilizing different hardware architectures. Equinix provides the neutral physical fabric to orchestrate that chaos.
Let's look at the actual statistics backing that up. The transcript notes that 8 of the top 10 AI model providers and 8 of the top 10 neoclouds are currently running their key networking workloads on Equinix.
I need you to decode neocloud because we all know the legacy hyperscalers like AWS and Azure, but neocloud sounds like something out of the Matrix.
Right. A neocloud, sometimes referred to as a GPU cloud, is a specialized infrastructure provider. Companies like CoreWeave or Lambda Labs. Unlike legacy hyperscalers that sell you everything from email hosting to basic web servers, a neocloud focuses almost exclusively on renting out high-performance compute, specifically GPUs, designed purely for artificial intelligence workloads.
So the biggest AI brains in the world and the specialized muscle required to run them are all congregating in these buildings. And that congregation creates a massive flywheel effect. The infrastructure attracts the top AI models. The presence of the top AI models attracts the Fortune 500 enterprises who want low latency access to them. The presence of the Fortune 500 attracts cybersecurity firms, data brokers, and network carriers.
It just builds on itself.
Exactly. The ecosystem's gravitational pull becomes almost impossible for a competitor to replicate simply by building a cheaper warehouse.
Here's where it gets really interesting. AI is the ultimate corporate buzzword right now. Every executive slaps it on their slide deck to boost the stock price. But Adair Fox-Martin did something different on this call. She broke down the enterprise AI demand into 4 highly specific physical use cases. I want to spend serious time on these one by one because it shifts the conversation from theoretical hype to actual engineering reality.
It is a critical framework. It moves past the generic idea of a chatbot and looks at how Fortune 500 companies are physically re-architecting their networks.
The first use case she outlined is what she calls the stack. She described this as enterprises running open models on private infrastructure to cut down on token costs. Can you walk me through the raw economics of that?
Sure. So if you are an enterprise integrating a public AI model, let's say you are using an enterprise API from a major provider, you are typically billed based on usage. This is calculated in tokens, which are roughly syllables or pieces of words. Every time your system sends a prompt and every time the AI generates a response, a meter is running, charging you fractions of a cent.
Which sounds completely negligible until you realize a global airline might be automating 2 million customer service interactions a day.
Exactly. Suddenly, your monthly operational expense for AI is astronomical and highly unpredictable. The stack use case is the enterprise reaction to that variable cost. An enterprise decides to rent their own physical servers inside an Equinix facility, pack them with GPUs, and deploy an open source model like Meta's Llama. They shift from paying a variable toll on every single word to a fixed, predictable real estate and hardware cost. For high-volume inferencing, running your own private stack is dramatically more cost-effective.
It makes total sense. It's like leasing a fleet of delivery trucks instead of paying FedEx for every single package. The upfront capital expenditure is higher, but your marginal cost per delivery plummets.
Furthermore, running a private stack means your proprietary corporate data never traverses the public internet to reach a third-party AI provider, which solves massive security concerns.
Which perfectly tees up the second use case she highlighted, sovereign, deploying AI for data residency and compliance. In the transcript, she specifically mentioned the new product in preview called Fabric GeoZones. How does data sovereignty physically work, and what is a geozone?
This is arguably one of the most important geopolitical developments in tech infrastructure. Data sovereignty refers to strict legal frameworks like GDPR in Europe, or emerging national security laws globally that mandate certain types of data, like citizen healthcare records or financial transactions, must physically remain within the borders of that specific country.
Meaning a French citizen's banking data cannot be processed on a server in London.
Exactly. But the internet wasn't built for borders.
Right.
The core routing protocols of the internet, like BGP, are designed to find the fastest, most efficient path for a packet of data to travel from point A to point B. If a fiber optic cable within France is congested, the internet protocol might automatically route that data through Germany or the UK to get it to its destination faster.
Which is incredibly efficient for loading a web page, but it is a massive multi-million-dollar compliance violation if that packet contains sovereign data.
Precisely. To solve this, Equinix developed Fabric GeoZones. It is currently in preview with about 80 global enterprises. It utilizes software-defined networking to fundamentally override the internet's natural routing instincts. It makes sovereignty a physical property of the network. A geozone creates an ironclad geofenced boundary. The network guarantees that the data will only travel along approved, compliant physical pathways.
And if it can.
If an approved pathway isn't available, the network will drop the packet entirely rather than route it across a restricted border.
That is wild. They're basically building physical border checkpoints into the fiber optic cables. If you are a multinational bank trying to deploy a unified AI model across 40 different regulatory environments, you cannot survive without that kind of physical guarantee.
Right, and they cited a real-world example of this on the call with FCX AI in Australia. They partnered with Equinix to build Australia's first sovereign AI inferencing node in Sydney. By keeping the entire hardware stack and the network routing strictly domestic, they provide a legally compliant pathway for Australian healthcare and government agencies to utilize AI without risking international data leakage.
Okay, the third use case is batch. The CEO described these as AI factories dedicated to model training and batch inferencing, noting that they are heavily reliant on liquid cooling. I want to dig into the physics of this.
The physics are the primary constraint of the entire AI revolution. Batch refers to the heavy, non-real-time lifting of artificial intelligence. When a company is training a new foundational model or running overnight batch inferences like analyzing 1 million satellite images, they're running thousands of the most powerful GPUs on Earth at 100% utilization for weeks or months at a time.
I remember a few years ago, I tried to build a high-end gaming PC. I put a top-tier graphics card in it, and within hours of playing a game, my tiny office felt like a sauna. The heat output from just one consumer GPU was staggering.
Now multiply that thermal output by 10,000. A standard enterprise server rack a decade ago might draw 5 to 10 kilowatts of power. An AI training rack densely packed with next-generation silicon can draw 50, 70, even upwards of 100 kilowatts per rack.
Wow. You cannot cool 100 kilowatts of thermal energy by just blowing cold air on it.
You can't. Air cooling fundamentally breaks down at those densities. Air simply cannot absorb and transport heat fast enough. You must use liquid cooling. This involves piping engineered fluids directly to the chips via cold plates, or in some cases, entirely submerging the servers in dielectric fluid.
Like actually dropping them in liquid.
Yeah, literally submerged. Water or specialized fluids are vastly more efficient at capturing thermal energy than air. The batch use case drives customers to Equinix because Equinix has the engineering expertise and the capital to retrofit facilities with the massive plumbing, pumps, and heat exchangers required to support liquid cooling at an industrial scale.
You can't just put an AI factory in the basement of your corporate headquarters. The plumbing alone would be a nightmare. Which brings us to the final use case, latency sensitive. This is about keeping the inference stack in a local metro to reduce lag.
If batch is about heavy lifting in the background, latency sensitive is about real-time human or machine interaction. Consider an AI agent performing real-time language translation on a live customer service phone call, or a computer vision model analyzing robotic movements on an automotive assembly line.
Right. If the robot is about to make a mistake, you cannot wait for the video feed to travel from a factory in Detroit to a centralized cloud server in Virginia, get processed, and send the stop command back.
The speed of light traveling through glass fiber is incredibly fast, but it is finite. Over long distances, you introduce latency measured in milliseconds. In real-time AI applications, a 150 millisecond delay destroys the user experience or results in a manufacturing disaster. Furthermore, backhauling raw, uncompressed video data across the country requires massive amounts of expensive network bandwidth.
So the solution is to decentralize the brain.
Exactly. You deploy smaller, highly optimized AI inference models in edge markets. You put the servers in an Equinix facility in Chicago or Istanbul or Osaka, so the processing power is physically sitting in the exact same metropolitan area as the user. This eliminates the speed of light constraint and drastically reduces the cost of long-haul data transit.
The transcript gave a perfect example of this latency issue with Raymond James, the financial services firm. They are moving to a hybrid multi-cloud setup inside Equinix specifically for low latency connectivity. Because in algorithmic trading, if your data takes 5 milliseconds longer to reach the matching engine than your competitor's data, you don't just lose time, you lose the entire trade.
The CEO also highlighted a networking example with Verizon. Verizon is utilizing Equinix APIs to integrate their adaptive network fabric directly into Equinix's interconnection hubs. It allows Verizon to provision near real-time network services for their enterprise clients. It all feeds back into the latency argument. Speed and physical proximity dictate the architecture.
So if we need all these specialized, liquid-cooled, legally sovereign, low-latency data hubs scattered across the globe that cannot be cheap to build, who is paying for the concrete and the massive power systems?
That brings us to the single most shocking number in the entire transcript found in the management guidance section.
The CapEx megaplan. The CFO, Olivier Leonetti, and the CEO announced the largest single guidance raise in Equinix's history. They bumped up their 2026 full-year revenue and AFFO growth metrics to the 11 to 12% range. But the jaw-dropper was a long-term outlook spanning 2027 to 2029. They plan to spend $5 to $7 billion annually in capital expenditures over that 3-year period.
$5 to $7 billion in hard physical assets every single year.
Let me push back on this heavily because when numbers get that large, they lose their meaning to a retail investor. Spending up to $7 billion a year is the financial equivalent of building a brand new small city every 12 months. It is an astronomical amount of concrete, generators, cooling towers, and land acquisition. How do they commit to that level of spend without drowning the company in debt or exposing themselves to catastrophic risk if the AI hype cools off and they're left holding empty ghost towns?
If we connect this to the bigger picture, it is the single biggest risk factor in their business model, and Wall Street analysts hammered them on it during the Q&A. But this massive spend relies heavily on historical execution and pre-sales. The CEO was adamant that this is a demand-driven capacity expansion plan. They are not operating on a speculative build-it-and-they-will-come philosophy.
So they aren't just buying farmland in Ohio and hoping Google shows up a year later?
No, not at all. To mitigate the risk of building a ghost town, they pointed out that a significant portion of their planned capacity additions for the near future are already spoken for through bookings. The tenants are signing non-cancelable leases before the foundations are even poured. Additionally, they are highly disciplined geographically. Over 80% of this massive CapEx spend is hyper-focused on their top 25 major global metros.
Wait, building in the top 25 metros doesn't eliminate the risk. If AI demand falls off a cliff, an empty data center in Chicago is just as useless as an empty data center in rural Iowa. Why does the location de-risk the $7 billion?
Because in those top 25 metros, the demand isn't just driven by future AI projections, it is driven by existing acute supply shortages. These are markets where Equinix already has massive established campuses with thousands of interconnected tenants who constantly need to expand their footprints. They understand the local permitting laws, they have established relationships with the power utilities, and they have the contracting pipelines in place. Expanding a highly profitable, interconnected campus where customers are actively waitlisted is vastly less risky than pioneering a greenfield market from scratch.
And speaking of profitability, they mentioned a target yield for these new builds that frankly sounds absurd for commercial real estate. They are targeting a 25% cash-on-cash yield at stabilization. Break down the mechanics of that metric because 25% is wild.
Right. In the commercial real estate world, if you build a high-end office tower or a shopping mall, you might hope for a 6 to 8% yield. A 25% cash-on-cash yield means that once a new data center is fully built and stabilized, which Equinix defines as roughly 3 to 4 years post-completion, the annual cash flow generated by that specific building equals a full 25% of the total capital it cost to construct it.
So if they drop $200 million building a state-of-the-art liquid-cooled facility, 3 years later, that building is throwing off $50 million in pure cash every single year.
Yes, which means the asset completely pays for itself in just 4 years of stabilized operation. After that point, the facility is essentially a cash printing machine for the remainder of its useful life, which can span decades. That astronomical 25% yield is the mathematical justification for spending $7 billion a year. The return on invested capital is just too lucrative to ignore.
Okay, the math works on paper, but you still need to physically locate $7 billion in cash every year to pay the construction crews. How is the CFO financing this without completely destroying their credit rating?
Olivier Leonetti walked the analysts through a very deliberate capital structure breakdown. First, they operate from a position of deep liquidity, holding $7.7 billion in available funds, which includes a recently expanded revolving credit facility. Second, their net leverage ratio, which compares their total debt to their adjusted EBITDA, is currently sitting at 3.6 times.
For context, in the telecom and infrastructure space, a leverage ratio of 3.6 is surprisingly conservative. A lot of tower companies or specialized REITs run closer to 5 or 6 times leverage, so they have massive headroom to borrow from the banks.
But they aren't relying purely on external debt. Their secret weapon is their dividend policy. As a REIT, they are required to pay out a portion of their taxable income, but Equinix currently maintains a dividend payout ratio of roughly 50% of their AFFO.
Meaning they distribute half their cash to shareholders as dividends, but they keep the other half in the war chest.
Because their operations generate such immense volumes of cash, that retained 50% represents a multi-billion-dollar internal funding source that requires 0 interest payments, 0 bank covenants, and 0 equity dilution. The CFO stated they will fund this historical expansion through a combination of that retained cash and selective debt issuance. He explicitly modeled that even while spending $7 billion a year, their net leverage ratio will only increase by about 1 single turn, moving from 3.6 to roughly 4.6 times by the end of 2029.
And that deliberate discipline allows them to maintain their investment-grade credit rating. Maintaining that rating is vital because it guarantees them preferential lower interest rates when they do tap the bond markets. He mentioned their blended cost of capital will only increase by about 150 basis points. They are betting heavily, but the financial architecture supporting the bet is incredibly robust.
Which leads us to the physical bottlenecks of reality. We can discuss financial models all day, but at some point you have to execute in the physical world. And building heavy infrastructure in 2026 is brutally difficult.
Let's talk about those supply constraints, because this is where the actionable insights for investors really crystallize. The CEO noted that to meet this demand, they are accelerating the delivery of more than 7,000 cabinets, pulling them forward from 2027 into the fourth quarter of 2026. They are practically tripling their delivery rate in the back half of the year. They have 52 major projects under construction across 33 global markets.
Yeah.
But there's a massive elephant in the room that is paralyzing their competitors.
This raises an important question. Where do they get the power? The ultimate bottleneck for the AI revolution is not the supply of NVIDIA GPUs, it is the supply of electricity. The global power grid is buckling.
We just established that a single AI training rack can pull 100 kilowatts.
Yeah.
You cannot just plug a 60-megawatt liquid-cooled building into the local suburban power grid and hope the neighborhood's lights don't go out.
You cannot, and utility companies will not let you try. Grid capacity is the ultimate moat in this industry. During the Q&A, an analyst specifically pressed management on their visibility into power supply. The CEO's response was staggering. She revealed that Equinix currently has 3 gigawatts of land under control.
3 gigawatts. We need to contextualize that scale. 1 gigawatt is roughly the total electrical capacity of a standard nuclear reactor. It is enough electricity to power roughly 750,000 average homes. Equinix controls the real estate and the power rights for 3 nuclear reactors worth of energy.
Of that 3 gigawatts, they currently have 700 megawatts actively under construction. But she reiterated their risk management philosophy. We are not speculative land developers. For those 3 gigawatts, the power is either already legally contracted with the local utility, or they have a highly confident documented path to energization. They refuse to announce a new project to Wall Street until it has cleared internal gating regarding power delivery.
Think about the competitive advantage that creates. If a private equity firm decides tomorrow they want to enter the data center market, they might have $5 billion in cash. But when they approach the local utility company in Virginia or Chicago to request 100 megawatts, the utility will tell them to get in line, and that it will take 5 to 7 years to build the necessary high-voltage transmission lines and substations. All the capital in the world cannot speed up a utility company. Meanwhile, Equinix has 3 gigawatts sitting in the bank.
But securing the power from the utility is only half the battle. The other half is securing permission from the local community. And this is where the industry is facing massive headwinds from NIMBYism.
Not in my backyard. We are seeing communities all over the globe, from Ireland to Northern Virginia, actively protesting and blocking data center construction. From a local citizen's perspective, a data center is a massive, windowless, ugly warehouse that strains the local electrical grid, consumes millions of gallons of water for cooling, and once it's built, it's mostly run by robots, so it barely employs anyone in the town.
It is a profound public relations and regulatory crisis for the sector. To combat this, Equinix detailed a highly tactical operational strategy on the call, which they call their U.S. Community Principles.
When I first read that section of the transcript, I rolled my eyes. It sounded like standard focus group tested corporate ESG buzzwords. But when you look at the mechanics of what they're actually doing, it's brilliant.
It is a calculated strategy to turn community relations from a cost center into an accelerant for zoning approvals. Being a good neighbor is how they ensure a multi-billion-dollar construction project isn't tied up in local environmental lawsuits for a decade.
Walk through the specific actions they take in these communities.
First, they directly fund energy and grid infrastructure upgrades. They aren't just siphoning power, they are actively paying to modernize the local utility infrastructure. The CEO mentioned she was recently in Washington, D.C. supporting the Ratepayer Protection Pledge. This is a public commitment ensuring that local citizens' electricity bills will not increase to subsidize the grid upgrades required for a new data center.
If you are a local city council member, protecting your voters from a utility price hike is the only way you survive the next election. What about the water issue? Liquid cooling sounds incredibly thirsty.
They are investing heavily in closed-loop systems and recycled water infrastructure to radically improve their water use efficiency. They are trying to decouple their cooling requirements from the local municipal drinking water supply. Furthermore, they address the employment critique by creating specific local economic pathways, funding skilled trade programs, and heavily recruiting military veterans to operate the facilities.
It fundamentally changes the conversation at a zoning board meeting. If a competitor demands a permit to build a power-hungry warehouse, the town fights them. If Equinix approaches the town and offers to upgrade their aging electrical grid, utilize recycled wastewater, legally protect citizens from rate hikes, and hire local veterans, the zoning permit gets approved. It's not just philanthropy, it's an operational moat.
As the CEO noted, they operate under the philosophy that they are not a visitor, we are a neighbor. While their competitors are mired in local zoning litigation, Equinix is breaking ground and pouring concrete.
So bringing all these threads together, what does this actually mean for someone trying to navigate this space? Let's distill this massive Q2 2026 transcript into the core takeaways. If you're looking at this stock, is this a bullish or bearish signal?
Based purely on the metrics and the physical realities detailed in this transcript, it represents a heavily bullish signal for their capacity to capture the infrastructure layer of the AI boom. The first takeaway is that their financial execution is structurally sound. When you strip away the one-time anomalies, the business is compounding recurring revenue in the double digits, structurally expanding margins, and maintaining historically low churn. The ecosystem lock-in generated by data gravity is intensely powerful.
Second, the AI narrative is moving past the hype phase and into the physical deployment phase. The fracture of AI into specific physical use cases, private enterprise stacks, geographically locked sovereign nodes, liquid-cooled batch factories, and low-latency edge deployments proves that AI requires a massive re-architecture of the global physical network.
Third, Equinix is backing up their market predictions with a historic financial commitment. A $5 to $7 billion annual capex plan is staggering, but it is heavily de-risked through pre-sales, targeted to supply-constrained major metros, and aimed at highly lucrative 25% cash-on-cash yields, all while maintaining an investment-grade balance sheet.
Finally, the barriers to entry are practically insurmountable for a new player. Controlling 3 gigawatts of power in a grid-constrained world and possessing the localized community strategies to actually navigate NIMBYism and get concrete poured gives Equinix a lead time that money alone cannot replicate.
Exactly. The moat is deep.
We've laid out the bullish case, driven strictly by the numbers they presented. But the goal of the deep dive is to look beyond the corporate presentation. I always want to leave you with a provocative thought, something to challenge the prevailing narrative as you watch this industry evolve over the next 5 years. What is the blind spot here?
Well, consider the massive historic centralization of capital we just analyzed. Equinix is building the centralized physical nervous system for global AI, pouring $7 billion a year into colossal megawatt-hungry central facilities. But the history of technology always oscillates between centralization and decentralization. Right now, there is a massive engineering push toward edge computing optimizing AI models so they can run locally entirely on your smartphone, your laptop, or a microserver inside a factory without ever needing to communicate with a massive centralized cloud.
So the question is, are we currently building the ultimate mainframe?
Exactly. Will the $7 billion a year being poured into these colossal central data centers today become the equivalent of building giant, expensive mainframe computer rooms right before the invention of the personal computer decentralized everything? If the most valuable AI inferencing eventually happens on the devices in our pockets, does this massive centralized infrastructure become a stranded asset?
That completely reframes the conversation. Are they building the pyramids of the AI era, or are they building the world's most expensive mainframes right before the PC drops? It's a structural risk that every investor needs to monitor.
It is the ultimate tension between the physics of centralized power and the efficiency of edge decentralization.
And that is exactly why we don't just read the top-line revenue numbers. We read the transcripts to understand the physical shape of the future they are building, so we can anticipate exactly what might disrupt it. Thank you to everyone for joining us on this deep dive. Whether you are actively managing a portfolio or just trying to comprehend the sheer scale of machines running our digital lives, we hope you walked away with a deeper understanding of the concrete behind the cloud. Keep translating the jargon, keep digging into the mechanics, and always question the numbers. We'll catch you next time.